crazy over there, but we can talk
Sounds
about
good.
it. All right, so welcome to Spinoff Investing Simplified's and Spinoff Investing Training Program, and we're going to talk today about return on capital and some of the things that Rich and I both use to identify a good business. And so, Rich from StockSpinoffInvesting.com, thanks for joining us today.
Yeah, good to be here.
All righty. So, first and foremost, are you guys handling the COVID-19 scare all right over there in Massachusetts?
Yeah, we are. I mean, I don't know how it is with you. I've heard rumors that we're going to have a 2-week shutdown where National Guard and the military is going to be kind of out in full effect to kind of prevent looting and make sure that everybody stays in their homes. I heard that might be on the way. That's just a rumor. But yeah, I mean, since last time we've talked about it, I think it's definitely intensified. I think I'm just kind of happy that everybody's taking it as seriously as they are. For a while there, it didn't seem like the administration was taking it seriously. And I think, I'm not an expert by any means, but I think clearly people need to isolate themselves, quarantine themselves, or else, there's no reason why, what's happening in Italy isn't going to happen to us in 2 or 3 weeks. So I'm relieved from that perspective. As you know, I work remotely, so my business really isn't impacted besides fewer people wanting to sign up for subscriptions when the market's down 20%. But I just feel for, I feel for people out there who work in coffee shops and restaurants. My sister's a vet. She's had her hours cut back, and she's pregnant, and she's going to get to the point where she doesn't get health insurance. I mean, she's going to be fine. She's going to figure it out. But there are people, it's impacting everything. So, I mean, I don't know how you feel. I feel like we're definitely in a recession right now. I think it's going to last for a couple quarters at least. But I would imagine that we'd be able to bounce back relatively quickly. I mean, there's no amount of money that the government won't print and send out to reignite the economy. And inflation hasn't been an issue, shockingly, in the past 10 years. So I don't think they're concerned about that. So, it's an unfortunate situation. Hopefully everybody's staying safe, but yeah, I mean, kids are definitely going stir crazy. I mean, I more feel for my wife because I'm down here doing my work, whereas she has to deal with the kids and have no museums to go to, no activities to go to, no school to park the kids at for a couple hours a day. So I don't know, how are you guys holding up?
Oh, it's about the same thing. So when you ask the question about the National Guard, let me speak to that because that I'm in the Guard.
Right.
So if you saw yesterday, there was a briefing from a National Guard general to Congress.
Yep.
And he was trying to defend not calling up the National Guard because of the separation. We're supposed to make sure we
right.
distance, because you think about calling in National Guard members. Just in my squadron alone, we have people from Northern California. They would come in from Illinois, they'd come in from Colorado, they'd come in from Washington, Montana, Oregon, and Idaho itself.
Wow.
and Utah. And so you want to think about a way, if they activated the National Guard and then sent them home in 2 weeks, a way to really spread the virus, that would be one of the ways to do it. And he tried to defend that.
Yeah.
And Congress was having nothing of it. But
really,
yeah, they're like, no, we need to do this. And I think the problem that would really happen, and just my own personal opinion, is that would cause additional hysteria and really worry in the local populace if we start having a bunch of National Guard members running around.
I mean, I think if that happens, I think the market's going down a lot more. I think it's going to be a buying opportunity. But I agree. Yeah.
So a very smart general. I'd have to look into the specific interview. I didn't keep it or anything like that, but that's something that we've been watching. I've been watching specifically.
Yeah.
But if they do start calling up guard members, that would definitely be something to pay attention to.
Yep.
As to our family being stir crazy, yeah, we went into spring break here, so we were going to have this anyway, you know, and it's kind of nice to be doing that. But
Right.
Kayla's been doing a great job keeping up with the kids. She does it a lot anyway because I'm always gone, so you know how it is. So
Yeah.
all right, well, yeah, I just hope you guys are doing well, and I hope you guys stay safe and hopefully, like you said, flatten the curve. I'm very concerned about my older family members.
Totally. I'm in the same boat.
And Jim would be one of those people that I'd be concerned about too, because I
Yeah.
know he's in that demographic that gets hit a little bit harder. And talk about a very smart fellow that I'd love to keep around. So
Yeah.
anyway, so this week we're talking about what makes a good business, and this might be more than just one 30-minute thing, because I don't know about you, but I started looking at it like I could share a small point to help people understand what I'm looking at to identify it.
Hey, Greg, you're kind of freezing.
Oh, my internet connection is unstable. Hold on a second. Are you still there? Did we lose our connection?
Still there?
Yeah, I'm here. I'm just checking the internet. Maybe Alexa took more bandwidth. My wife's helping me out. So, yeah. So, where were we? We're going to talk about the things that we look for just companies in general. What makes them a good business? And this will probably, I'm sure there'll be more than just today that we talk about this, just given how broad that is for a thing to do. Thanks, honey. Yep. All right, cool. So do you want to go first, or do you want me to?
You go first.
Okay, all right. So what I'm looking for with a company is I'm looking for something that allows me to have a good return on capital. And I don't use, so return on capital is a really interesting metric. I know that there's proper ways to do it, but I use the one that that Joel Greenblatt uses. And so let me get here. And this is my, like a spreadsheet that just goes on a house rental. This is actually a rental that Kayla and I have, and this is how we identify the return on capital for it. Now, it's not a perfect thing. Sometimes there's a little bit of an art that goes along with this, but we start, when we do return on capital, we start with our annual rents. So I'm guessing you can see this, right?
Yep.
So our annual rents on the property is $9,000. We like to keep a cushion of about 3 months of rental costs and maintenance costs in reserve at all times on that, just because we don't want to have issues in a pinch. And then we have current liabilities, and so this is for a house. It's super simple because it's my principal that I pay and my insurance payable. And then I also, this isn't a liability, but this is something that I recognize as an expense, is my maintenance and my management costs. And so what I will do, and then the property itself, it's worth $49,000. Okay. So I first figure out the net current assets, and I actually do it in this order because I think it gives you an idea of what kind of business this is. And you'll notice one thing that happens is the net current assets is actually negative. This is something that I have noticed with some of the companies that really have a good moat, is that sometimes they have a net current asset that is negative, because they can extend the cost or the length of their suppliers, their supply chain, or they have so much turnover in their market that they can keep it really, really low, and they don't have to keep a lot of cash on hand in order to do it. And so the property is actually the networking, or the property, plant, and equipment net. So I subtract the yearly depreciation. This is about 5 years into us having this particular property. This is calculated for 5 years in. And so our net working capital is about $40,000. That includes the property itself, and then it includes all the yearly depreciation expenses that we've had on it. And then what we would then do is we take our annual rents, we subtract out our maintenance and management costs that we would have on that, and then we divide that into the net working capital. And that is how I identify my return on capital. I know it's not exactly the same thing as you would see in a textbook, but this is how I look at it, because this is how I would invest in something. Joel Greenblatt uses this same thing. He uses EBIT over the net working capital of the company. And he does the net current assets, or the net current, the net current assets plus the net working capital, and that is how he identifies what he's using as his denominator. So
that looks like a great investment.
It's been a great investment. Kayla and I, when we bought this, we realized that this was, we live on the same property. And so this is our house, and then it's also our rental, and the rental essentially pays all of our costs of living.
Yeah, that's awesome.
So yeah,
my brother-in-law has the same situation where he is basically he has like a big house, but there's also an apartment attached to it, and he basically does the same thing.
Yeah. So this, I do this basically just so that people can see what I'm looking for, and then I'm going to now pull out. We talked about using Garrett Motion.
Yep.
Pull out the Garrett Motion and how I calculate the same type of thing. Now, Garrett Motion is a really interesting and difficult case to look at because of the asbestos liability, which we don't. Who knows what will happen with this and how it'll turn out. We talked about a little bit about the litigation that is with it. But I start with the debt on a company. So I do it for the past years just to kind of see what kind of trends are going along with this. I'm adding in the asbestos claim. I'm also doing it without the asbestos claim just because I read a while ago.
Hey, Greg, are you? I can't see the Garrett Motion spreadsheet.
Oh,
have you shared that yet?
I thought I shared that.
I'm still seeing the home rental.
Yep. Let me share this. So, new share. Okay. You have it now?
Yes. Perfect.
Okay. So I just stick it into a spreadsheet, and I like to use something simple that helps me just understand the business a little bit better. And I start with the debt. So I look at the balance sheet first, and then I've got the asbestos claim, as we talked about earlier. And then we have the cash that they have on hand. And then, I hope the internet, it's telling me it's unstable. So hope the internet's still working. Yeah, we've kind of had a really weird thing with me. Sorry about that.
No worries.
And then I basically calculate the net debt on the company. So current debt minus cash. And then I add any other equity claims that you find on the balance sheet. And then I add the shares outstanding at the market price as my equity. That allows me to do the other calculation that Joel Greenblatt does, and that is to he does his earnings yield calculation, but that we're not going to get into that today because we're just talking about, is it a good business? And so looking at Garrett, there's a couple of different ways that you can then find that's how you find your denominator, which is your enterprise value down here. And so I calculated both just because I want to understand what the business is like with and without it, to make it a good comparable with like some of their competitors like Borg Warner. the operating earnings on this particular company is one of the things. People would also call this net operating profit after tax, I think is the other way that people call that. And then you have your free cash flow, which I've calculated here. So I have operating earnings on this line. I have my free cash flow here, and you can see the things that I put in there. When you make this calculation, or when I make this calculation, capital expenditures is sometimes left to a little bit of judgment on our part, because we have to identify what do they actually need in order to maintain their business. And that's really what they would do. In that rental experience or example that we were talking about earlier, that capital expenditures would be my maintenance expense. Then you have your net income, taxes, and interest expense. And this is how Joel Greenblatt talks about it in his Magic Formula book, how you do your EBIT. Just you calculate earnings before interest and taxes, and then throw that as your numerator. And so I have 3 different ways that I do it, but I then take those and then I look at all 3 of those different ratios for it. But then the focus with Garrett, then I identify return on capital. Now, this is not the same return on capital that you might see on other websites with it. It's just because I have identified how I want to calculate it. And I know that is where you can get really dangerous. But I do that over the earnings before interest and taxes, and I left out net working capital altogether, just because it is negative. Because if I left it at, if I put in the net working capital, or the net net assets of current assets and liabilities, it would be astronomically high, like 6,000% or something like that. And that tells me, okay, we need to pay attention to this, and we need to look at it and identify what really matters for the company. And so that's how I've calculated this particular company's return on capital, is how much earnings before interest and taxes comes off of the purchase price of the property, plant, and equipment.
And you said that you were breaking up a little bit, but I think Greenblatt, or at least the way I remember it, is he also includes, so he usually does EBIT divided by net PP&E plus net working capital, so current assets minus current liabilities. But you said you do not like to include net working capital. Just remind me why that is.
I do like to include it. In this case, I did not. And the reason why is this. This is the actual denominator if I do that. Which means that right now, Garrett Motion would be trading, it has an earnings before interest and taxes of 257 over the net assets for operations, which is right here at 42. And it would actually, well, in 2017, it would have been negative.
So you're saying that if you add net working cap, so basically net working capital is negative. Is that the message here?
In this case, and that's the reason why I did not include that in my calculation for the return on capital.
Yeah, because it makes it kind of infinite, basically.
Yeah, and I know that that's not right.
Yeah.
And so I have to look at it, and I have to spend my time. And so I come up then with my return on capital. Over the last couple of years, they've averaged over 50%. So what I'm looking for is a company that does at least as good as what we did with our rental real estate. So I want to have something that has about 20%. And I've made this mistake with not doing this calculation prior, but the more and more I look at it, this seems to be the thing. I'm looking for a company that has good operations. And if they can do at least 20%, then to me, that's a good business. It's not just Joel Greenblatt that seems to use this thing. I've seen similar calculations that Warren Buffett talks about when he talks about his letters to shareholders. He does a similar type of calculation. He talks a lot about sees Candy being a perfect
Mm-hmm.
franchise, and the franchise is that their net working capital doesn't get very much bigger. They don't have to add a lot of investment to continue to raise the prices and stuff like that. And so I'm looking for companies that have that. That is the beginning of, is it a good business to me?
Mm-hmm. Mm-hmm.
So anyway, that's what I have. I'd love to hear your thoughts on this, and then we can talk about what you have.
Yeah, I mean, this is really helpful. I look at it pretty much the exact same way. So, everybody has their own kind of return on capital, return on invested capital calculation, but I do the Greenblatt method too. And it's kind of like return on tangible capital. So it's not return on your equity and your debt. It's return on the physical capital that you actually have to use to run the business. So that's, what current assets do you need? And then what net property, plant, and equipment do you need? And that's just a good way to quickly, I do that on all the companies that I'm looking at. And it's a quick way to figure out if this is a business that can basically grow without having to invest a ton of money in building new plants and new enormous capital CapEx projects.
Yeah. Well, cool. I hear you have some slides. Did you want to share them?
I do, yes. Let me see. Let me just pull them up here.
I think if I stop sharing, it should allow you to get in there.
Okay, let me see. Okay, can you see my slides?
Yep.
Okay, so business quality. This is probably the world's worst slide deck, but I literally threw it together in about 10 minutes. So apologies for its ugliness. But I was just basically thinking, when you're talking about, we're going to talk about what makes a good business. I just did some work on Change Healthcare, which you're a subscriber. You know that I just published an investment case on it. And to me, it's a great business. And so I thought I would kind of walk through some of the reasons why I think it's a great business and some of the analysis that you can apply to other companies as well. So business quality. So this is the exact same calculation that you talk about. So this is one that I do for basically all the companies that I'm looking at, but it's basically return on invested capital as defined the way Joe Greenblatt likes to do it. And so, what I've done is, you have your current assets, which is going to be your cash, your current receivables. You have your net liabilities. That's going to be short-term debt, short-term payables, and then or accounts payables. And then if you subtract the assets from the liabilities, you get net working capital. And then you have net property, plant, and equipment. So this is just hard, hard assets. What actual equipment do they need? Do they have to spend? What buildings do they need to buy? What factories do they need in order to create the product that they're creating? Now, the beauty of software companies, and Change Healthcare is a software company, is that they don't need factories to produce their property. There's very little capital expenditure that's required, and that's why one of the reasons why software businesses are so good. So you basically add up your net working capital and your net PP&E, and that's your invested capital, 381. And then the operating earnings is the same thing, Greg, that you had, which is just EBIT, basically. So earnings before interest and taxes. And so you just divide operating earnings by invested capital, and you get a really high return on invested capital of like 80%. So this just shows that it's a relatively low capital intensity business that generates very good returns for those hard investments that you need to make. So that's I think this is how Greenblatt defines what is a quote unquote good company. If it is a high ROIC, it is a quote unquote good company.
Absolutely.
That I look for. Or Greg, did you want to jump in there?
Yeah, let's talk about that for a second, if you don't mind.
Of course.
So let's see. If I do this, will you? You probably can't see my mouse coming across here. So the things that I like to point out to anybody that's looking into this is your current assets and current liabilities. again, that's one of the things you have to pay attention to in the net working capital, because it can get to a point where it goes crazy if it is a net working capital that is negative. The other side is just when we talk about that net plant, property, and equipment, that includes the depreciation that we were talking about at the very beginning with the rental property. And so you're looking for something, you need to understand that that can be in there. Now, my question to you, and I've thought about this a lot, but I haven't come to a conclusion of what I would do with this. With a software company, they have to put money into software itself, and sometimes they use that as a depreciable asset on their balance sheet. You don't use it, and I wouldn't either, but I'm just curious, have you ever thought why we don't use that as one of those requirements? Because it is a cost of capital for the
kind of like R&D investment that's capitalized. Yeah, so it's a really good question. In the sense of change, I don't think it's very meaningful. And the vast majority of expenses that change has to incur are just operating costs. So they're kind of factored into your operating earnings number. Like, a lot of it's, SG&A, that's not a capital investment. They have some R&D, that's kind of coming down the income statement. But for the most part, I'd have to double check, to be honest, but I don't think it was too meaningful of a number, just kind of going off memory. But it's a good question.
Yeah. I'm not saying that you have to, and I know that if you're a purist and you follow Greenblatt's stuff perfectly, he says not to do that. But it's just something interesting that I've thought about often when I've done this calculation on a software company. So
yeah.
All right, I don't mean to interrupt you more. Go ahead.
No, jump in. This is good. Okay, so just going on to the next slide. So these are this directly factors into the previous calculation. So basically capital intensity. The more, as a general rule of thumb, the more capital intensity of the business, the lower quality it is. And so the net PP&E number, so Change Healthcare is going to be spending $250 million of CapEx this year on.
Hold on. Sorry. All right. Sorry. Start over. I didn't mean to have the phone go off on you there.
No worries. So Change spends $250 million annually on CapEx, and so it's important to put that number. That number in and of itself isn't good or bad, but if you compare it to the revenue of the business, it represents 7.7% of revenue. So that could be high, that could be low. You have to compare that to the margin profile of the business. So in the context of Change Healthcare, their margin profiles, their EBITDA margins are about 31%. So 7.7% of revenue is a relatively small percentage of your EBITDA margins. And so I would view this business as a pretty capital light, a low capital intensity business. But say you were looking at a business with 10% EBITDA margins, right? Then that's a business that's generating, 10% before paying interest and taxes, and 10% of revenue. And you also have to spend 7.7% of revenue on CapEx. That's a lot. There's not much room left over for shareholders after that. So in the context of if you were looking at a lower margin business, 7.7% would be a lot. Would be considered relatively a high capital intensity at a lower margin profile. A good example is Resideo, which is a spinoff of Honeywell. So just going by rough numbers, one of the things that they touted going into that spinoff was it was relatively capital light, like they don't have to spend that much on CapEx, which is true. They only spend, I think, 95 or call it $100 million a year on CapEx, but it's a pretty low margin business. That business only generates going in like 9% EBITDA margins, but they've been guiding that down, and it's close to 7 or 6% EBITDA margins now. So even though CapEx is called only 2% of sales, as a proportion to your EBITDA margins, especially if your EBITDA margins are shrinking, it could become an issue. So it's really, I guess, the point here, the important point here is to compare kind of the operating earnings margin or the EBITDA margin of the business versus what percentage of revenue has to be spent on CapEx. And you want the difference to be very large.
Okay. Yeah, this is an interesting calculation to do. So you jump into doing EBITDA, even though you've already done EBIT for the previous calculation. Why change the? Yeah, I'm just asking.
Good question. So no reason. So you would basically find the same. You'd basically find pretty much the same relationship. So I just use EBITDA margins because that's a number that I had handy for change. That their EBITDA margins are 31%, but their EBIT margins are probably closer to, call it, 25%. So even if you use EBIT margins, it's still a very large difference between the margins and the percentage that you're going to be spending on revenue. And then yeah, I mean, if you do use EBIT, that also factors in depreciation, which should approximate CapEx as a percentage of revenue. So I guess you'd be double counting if you were to use EBIT versus CapEx as a percentage of revenue.
Yeah, that's
you'd basically be double penalizing kind of a CapEx charge.
Yeah, which could cause a mistake. So I guess we don't want to do that. I'm just every time that I've looked at CapEx, though, it seems like no matter what it is, it's always too low. I've always felt like the rental on our house.
Yep.
Our maintenance expense annually is about $900, but that comes in lumps, And so
right, of course.
There'll be 2,000 one year and then 200 the next. So it's very lumpy in the way that it comes in and out. So
totally. Yeah, and then the other point that you made that we can kind of emphasize is that, yeah, CapEx, there are two different kinds of CapEx. One is maintenance CapEx, like how much is it going to cost to just maintain your project? And then how much CapEx are you going to have to spend to grow? So say you want to grow, say a company wants to grow, and they're going to build another factory to make widgets or to make turbochargers. That would be considered growth to CapEx. That's not CapEx that's needed to kind of maintain the current earnings power of the business. So there's it's an important distinction. And I mean, you can ask management what maintenance CapEx is, or investor relations, and they'll give you a number. Usually they kind of I don't know, say that maintenance CapEx is actually lower than it probably is. So they say, oh, we only need to spend $10 million on CapEx, but for the past 10 years, they've spent $100 or $150 million. Well, maintenance CapEx is probably higher than $10 million. So it's like everything in investment. It's kind of a judgment call, but it's an important distinction between growth CapEx and maintenance. You shouldn't assume that all CapEx is necessary or maintenance CapEx.
Yeah, I've had the same experience where that maintenance CapEx is really difficult to find. Sometimes you have a hard time identifying, hey, this is how much it actually costs to maintain this company. And I think that's a real life example in just running a business or running an investment anyway, because I've observed that doing the rental property. I'm like, okay, I know that sometimes it's going to be high, sometimes it's going to be low. I still have to make those payments to keep the property rentable. So
yep, that makes sense. And then the last slide that I had was just, I mean, this doesn't have to do with returns on capital, but it's questions that I ask when I'm analyzing a business. What percentage of revenue is recurring? So with software businesses, like Change Healthcare, they say that 88% of their revenue is recurring. So essentially they have, contracts, or they give, hospital payers and providers licenses. And, to give you just one example of what Change does, they have software that basically analyzes healthcare claims to make sure that those claims are filled out properly, so they'll get reimbursed by the insurance company. So the healthcare provider would pay kind of, a per fee or per user a fee, either per year or per month, to basically get access to that software. And unless something goes horribly wrong, that healthcare provider is probably not going to be switching out that software solution. So as a result, the revenue is recurring, and then it tends to be getting into the third bullet point. Are there high switching costs? Would a company, if a competitor wanted to come in and pitch their new software service, how big of a sell would that be? Would that be a relatively hard pitch to make? Would the brain damage that the provider would have to go through to sign a new contract with a new provider be worthwhile? So that's another question that you want to think about. Could customers easily switch out and use another competing competitor to provide essentially the same product? And then the third point is just, is it cyclical? So in general, the market does not like cyclicality. Cyclical companies trade at low multiples generally. So, all things being equal, the more smooth a company is, the more stable it is, the higher the multiple or the higher the valuation, for better or worse. That's kind of the way the market works. And so again, with Change, it's a healthcare business. People, when they get sick, they still have to go to the doctor. Claims still have to get reimbursed. The insurance companies have to analyze the claims and decide if the claims are correct or if they've been filled out incorrectly, and decide how much to reimburse. So they need these software solutions that Change provides, and they're going to need them, whether we're in an economic recession or an economic boom. It's pretty stable. So that's another another factor that I look in when I'm deciding, is this a good business that I would want to invest in?
Yeah. Well, I think, so you're talking about a second part of the business, and that is how you identify what Warren Buffett might call a franchise, or you might have moats of some sort that make it difficult for you to get into the business. And I was thinking maybe next time we get together, we should talk about that. Like, how do you identify a moat? So
yeah, that sounds good.
So awesome. Well, guys, thanks for joining us with this particular video. I think that we had great overviews of, hey, how do you identify a good business? And it's only the beginning, because I'm sure that we need to talk a little bit more about some other specifics with this. I do like what Rich is talking about with the cyclicality and understanding how a cyclical business operates. I've learned a lot about that with KLXE and the investment that I've had at that company lately. But I'm sure life will be okay. We'll still get up tomorrow, and we'll be all right. So maybe we could talk about that when we talk about cyclicality. But just to let everybody know, as we finish up, we want to make sure that you recognize that these are not recommendations to buy any of the companies that we've mentioned, and because we are not your fiduciary advisors. We recommend that you do your own research on these companies before you commit any of your own funds. And we appreciate you coming along. You have anything you want to say before we close up, Rich?
No, excuse me. I think you covered it. Yeah, just everybody be safe, stay healthy, continue to quarantine yourself, and hopefully I'm sure we'll all get through it.
Awesome.